what's going on? Jerry Fetta here, owner, founder, CEO of Wealth Dynamics. Hope you're doing fantastic tonight. Welcome to another installment, another week, another episode of Finance Friday. Every week I come to you with these Finance Friday courses. So this week on Finance Friday, what I want to talk to you about is how to self-direct your retirement account. Okay? Right now, there's a trick to this, and it's something that as a financial advisor, because you need to keep in mind, I was a licensed financial advisor for a number of years. I worked with Dave Ramsey. I did all the mutual funds, the retirement accounts, you name it, I've done it, right? And this was something that as an advisor, I was never taught about. Okay, so what I want to teach you this evening is I want to teach you the ins and outs of this, and I want to show you how to do it in the least expensive way, right? Where you've got the most access, the most control to your funds to be able to use your retirement and investment money for things like real estate, precious metals, right? And these are not your typical thing that you'd get from a retail financial advisor, okay? So what I want to jump into first on this is I want to just basically dive into some of the key terms we're going to go over, right? So a retirement account, this would be something like an individual retirement account or your 401k plan, or 403bs, all sorts of different accounts you might have through your own work, past employers. Maybe you set one up yourself with a financial advisor, right? Now, retirement accounts typically have the rule that you can't access the funds right away. So this is one of the downsides of a retirement plan. You put money in, you might get a tax deduction, you might get tax advantage growth, but typically you lose access to your money till age 59 and a half. And often you're very limited on what you get to invest in, right? So if you're tracking with me, think about this. Like if I were to put money in an account and I had, let's say, a high interest in investing in real estate or investing in precious metals or investing in small businesses, if I put my money in a traditional retirement account, I can't do those things, right? That's off the table. It's not something that's an option, right? Now, not only that, when I put my money in a retirement account, I'm also going to pay an astronomical amount towards my cost of fees, right? I'm going to dive into that with you this evening as well, right? Because the fees really add up. And if you think about this, it's like, okay, I'm losing control of the asset. Maybe I don't want to invest in mutual funds, right? A lot of my clients that do these retirement plans, they don't want to invest in mutual funds. They're not interested in the stock market. Right? If they did, like they would be putting money in retirement accounts and that would be that and they'd be happy with it. Okay? Now, if you think about it from the standpoint of what your goals are with investing, shouldn't that be a primary focus? Like, shouldn't I put money in something based on what is it that I want to invest in? What are the things I'm interested in, not what someone else told me was a good idea or what all my friends at work are doing or any of those types of things. Okay, so really it should start with what am I knowledgeable on, what am I interested in, right? What fits me as an investor, what fits my goals, and I don't want to invest in things that don't match up with all those things. And a retirement account is going to limit me to those types of investments, right? And I don't want to be limited. So I'm going to share some of this on my whiteboard really quick, right? So you've got two different schools of thought here, right? You have what we're going to call captive, and you have what's called self-directed. Okay, so with captive, like what's happening with captive? Again, limited options. Right, you're only going to have what? Mutual funds, stocks, bonds, exchange-traded funds. These are not things I'm interested in investing in. And the reason why is a lot of times they're not backed by a real asset. The intrinsic value is very low. They're not a high income producing asset. It's something where I need to sell my shares in order to generate income down the road. And it's not something I have a high degree of control over. Now, the other big problem with the captive retirement model is fees, right? Typically, I'm going to pay asset management fees. Right? And these fees really add up. I want to show you tonight the impact of fees. Okay? Now, the other thing here is I have less flexibility right? Why? Because I'm at the mercy of what's called my custodian. I'm going to dive into what that means this evening, right? So we've got captive, then we've got self-directed. Self-directed, you have almost, I'm going to use the word almost here, almost unlimited options. Right? I can invest in all the stocks, the bonds, the mutual funds, all the things you can do in a captive account. I can do that in a self-directed account. But I can also do real estate. I can do raw land. I can do seller finance mortgage notes. I can do private placement investing. I can do gold and silver. I can do gold leasing. Like there's so many different things I can do. It's like, why wouldn't I want more options? Why would I want to be limited to Fidelity and American Funds and Vanguard and these normal things we see in the captive atmosphere? Okay. Now, the other thing here is my fees. Fees are lower and they're typically flat dollar amount. You're not paying percentage-based asset management fees. Okay, and then finally, I've got more flexibility. Right, I can do, let's say for example, just to give you guys something to think with on this, let's say I have a traditional IRA and I've got that with Charles Schwab, or I've got that with Vanguard, or I've got that with, you know, Fidelity, or any number of these financial providers that would sell me an IRA, right? And if I've got one of these, it's probably in mutual funds. I'm probably paying percentage-based asset management fees, and it's just going to sit there till I'm 59 and a half. And when I pull the money out, right, like I'm going to have, you know, my taxes and all this stuff happen, but it's just going to sit there and defer and grow. Okay. Now, let's say I do a self-directed account. Traditional IRA, move it over from Charles Schwab. I move it into my self-directed account. Right? I could put it in real estate. I could put it in metals. I could put it in gold leasing. I could put it in so many different options. My fees go down, right? And let's say I want to start a business and convert my IRA, my self-directed IRA, over to a self-directed 401k. Right now, why would I do that? Because 401ks allow me to do things like increase my contribution limits to lower my taxes, or take tax-free plan loans where I pay myself interest, or buy things like life insurance or life settlements, right? More flexibility. Charles Schwab is not going to do that. Now on the back end, let's say on the taxes, because everyone knows you're going to put the money in, you're going to pay the taxes when you withdraw it, right? If you're self-directed, the rules still apply, but the chances are, if you're working with a company like mine that does self-directed accounts, you're going to have someone that's a little more strategic and open-minded towards tax codes and planning and things that aren't just your plain Jane, vanilla, run-of-the-mill techniques and tactics. And with that being said, there are ways to offset the taxes when you withdraw for retirement. So instead of paying 20, 30, 40% in taxes, what if you could pay 10 or 0, right? And that would just come from good planning and working with someone who thinks outside of the box, right? And obviously you need to be educated on these things too, right? But I want to go over some of the options, right? These are just some of my favorite ones, and I want to start here. First things first, every single retirement account is going to have what's called a trustee, right? So you're going to have a trustee. You are also going to have a custodian, right? And you are typically going to have a management company. We'll call this an administrator. Right? And basically the other part of this is your financial professional. These are the main things you have, right? Okay, so what does a trustee do? And this is going to happen on any retirement account. So whether you're with Charles Schwab, whether you are self-directing, a trustee is basically setting up plan docs, right? That is the main thing that they're going to do. They're going to set up the plan docs. They're going to keep you legally compliant, right? Making sure your documentation is good in good order. It's updated with the latest things in the tax code. It meets all of the IRS rules and regulations. Okay. Now, you are also going to have a custodian. A custodian, they're going to hold assets. They're going to hold cash and assets. That's your custodian. Okay. So every company that does retirement accounts is going to have a custodian. That's a run-of-the-mill thing. Okay, now you're going to have an administrator or a record keeper, and that's what they do. They keep records of transactions, right? So that's here, and then you've got your financial professional. They are going to help you select assets, right? That's the main thing a financial professional is going to do. Okay, now over here, you also have what's called your investment provider, right? And the investment provider does that. They provide, and let's call this an asset provider because they might be doing insurance products and those are not necessarily investments, but you're going to have an asset provider, right? An asset provider, they're going to provide asset options. Okay, so these are your different groups. This is who's involved in most retirement accounts. And what happens is when you have a captive account with a Wall Street firm or with a bank, okay, they are originally an asset provider. In almost every circumstance, they started out as an asset provider. How do we know this? You know this because the IRA, the traditional IRA, didn't come out till the 1970s. You know this because the 401k plan didn't come out till 1979. You know this because the Roth IRA didn't come out till the late 1990s. Most of the companies that offer these predate those time periods, meaning back in the day, before there was a traditional IRA or a 401k plan or a Roth IRA, they just sold mutual funds. They just sold stocks and bonds, right? They were an asset provider. Now, once the retirement world became a thing, they then became trustees and custodians, right? And then they got into the business world on let's sponsor your 401k plan, but let's captivate all of the money and let's put it into our own assets, right? It's just a feeder system into their financial products. It's their business model, right? And oftentimes they're also going to wear the hat of plan administrator. Now, they might build their own force, a sales force of financial professionals, or they might allow financial advisors, right? But that's what that is. Your financial professional, typically they are going to be working for the asset provider. They're going to earn commissions, fees, etc. for recommending the assets that they recommend. Okay, or they might objectively recommend them and charge their own fees. Either way, similar arrangements. They're distributing the products and services of these asset providers. Okay, that's your Edward Jones, your Merrill Lynch, your New York Life, all of these different groups, right? Now, what is the difference with self-directing? Self-directing, let me go back here. I just deleted the whole thing. I didn't mean to do that. So self-directing, let's go ahead and just retype some of these things out. A self-directed provider is just a trustee and custodian, and they might be an administrator, depending on what they're set up to do, right? They are not an investment provider. Right, so what does that mean? That means that you, as the individual, would be responsible for, number one, setting up your account. Number two, selecting assets. Number three, managing. Right, now, my company, we help you with all these. A lot of times you might not get that with a self-directed provider. You don't generally get a representative that's going to help you set up your account, help you learn about different assets you could invest in, help you, with managing things on an ongoing basis. A self-directed provider is not going to do that. They're just going to set up your documents. They're going to keep you compliant. They're going to keep transaction records. And they are going to hold cash and assets. Those are the main things they're going to do. They're not going to generally help you fill out the paperwork to set up the account. You would go on their website and do that by yourself. They're generally not going to educate you on various investment options to help you select the assets. They're generally not going to help you manage what's going on in the account, right? So you have kind of this dichotomy, this vast difference of, I'm either a Wall Street guy, a bank guy, and everything's done for me, but I only have mutual funds and I pay astronomical fees for that, and I get, mediocre or subpar performance. Or polar opposite, it's the Wild West, and I'm going to now set up my account and do it all by myself and learn how to be an investor and do everything without any assistance. What my company does is we're a middle ground, right? We come right in the middle and we say, hey, we're going to help you with self-directing. But again, the key word is help, right? You're going to get assistance with all of these different aspects so that you're not going about it alone, right? Because the average person, they're not used to that. If I'm honest with you, when I first learned about this stuff, guys, it was confusing for me, and I was a financial advisor. I had no idea that you could do a self-directed account and set up, real estate and different investments in it, right? That didn't cross my mind. And so when I first did it, I remember the guy I was working with, his name was Munzer, right? Good old Munzer, like he didn't provide a whole lot of help. There's a lot of me having to figure it out and having a hard time, even as somebody that was a licensed financial advisor, right? So now that we've cleared up some terms, let's go into what are some of the options here, right? And some of my favorite options with a self-directed account are going to be based on the amount of money you're putting into it, right? And I'm gonna break this down, and some of these are gonna be technically self-directed options. There's one of them that's not, but it's very similar, right? So the first thing is if you have less than $10,000, right? This is basically going to be precious metals, right? And if you have less than $10,000, like self-directing, it can work for you, but honestly, you need to contribute more to your account. You need to build up the value because you're paying a flat dollar fee. So let's say your annual fee is $400, right? Well, if you've got a $100,000 account value, that $400 is cheaper than anywhere else you're going to see on the marketplace. But if you've got 10 grand, that $400 fee is going to make up probably most of your returns. So you want to grow your account value, okay? Now, if you have 10,000 to, let's say, 30,000, right, I would actually do a alternative index annuity, AIA, an alternative index annuity. This is an annuity, it's an insurance product. Technically, it's not self-directed, but you can use real estate or metals indexes, meaning you can get the growth, the upside of real estate or metals without any of the downside and no fees, right? And if you've got 10,000 or 30,000 to 30,000 minimum, that's a good range if you're trying to move money over and be in real estate, but maybe you don't quite have enough to do the real estate yet. Okay. Now the other one would be, and you could still do metals in this range too. Like you could do an annuity or you could just do precious metals. Right? Now if you are 30,000 to let's say 50,000 or more, right? I would actually do what's called gold and silver leasing. Okay, now in a self-directed account, you need 30,000 minimum. Your self-directed account is going to need to set up an LLC. Why? Because a self-directed IRA in and of itself can't do metals leasing. It can't do gold and silver leasing. So you need to set up an LLC owned by your self-directed account. The LLC can open up a bank account. The LLC can do gold and silver leasing, and all of it's owned by your IRA, right? That's totally fine. Okay, now again, this is where we help people. Like someone's like, cool, I need to set up an LLC now and a bank account and do this and figure out how to do gold leasing. Don't worry about that. So if you're listening to this or watching this, that's something we assist you with. Okay, the final one here is if you are 50,000 or above, right? This is where you can do real estate, right? And I don't love doing rental properties in an IRA. I think that that's cumbersome. I like doing seller finance. It's more hands-off, right? And then the final one is if you're accredited, you can start getting into what's called private placement investing or even angel investing, right? That's a higher risk way of investing. I have lost money doing these things before, so I like to caution people, don't be like, I'm accredited or I'm going to get accredited, then jump right into that with no knowledge, right? So you want to build up to it. But these are all things you can do in a self-directed IRA or a self-directed 401k. Right? Now let's talk fees really quick before we wrap up for this evening, okay? If you are investing with a self-directed account with my company, right, because we have our own self-directed account platform, you're looking at typically a one-time setup fee of $50. Then you're looking at an annual fee of generally $400 per year flat. That's usually about it. You might have a one-time wire fee or a transaction fee that might be, $10, $30, somewhere in that range, right? but that's very inexpensive. Now, I want you to be thinking with, what do you usually see in a Wall Street plan? Right now, Anderson Business Advisors, a law firm out of Nevada, they did a study and they showed that the average mutual fund investor is paying generally 3 to 5% per year in fees, costs, and drag, money that does not get invested. You don't see a return on it. It turns into a drag and brings your performance down. 3 to 5% per year. If you really dig through the prospectus. Now, if you're working with an investment advisor or a fee-based financial planner, you're in that range or higher because they're probably charging 1 or 2% as well, right? But let's just say I'm wrong, right? And it's only 1.5%. Let's say you're paying 1.5% per year in fees with Wall Street, right? Let's take a look at this. Like, I just want to show you the differences here, right? Now, the average retirement balance, generally, with just the run-of-the-mill anybody we're talking to, usually that's going to be about 70 to 100,000 minimum. So let's say it's a $100,000 account, right? If you're paying a $400 fee a year on a $100,000 account, that makes up a fee total, like all in, if you do the math on this. You're looking at an annual fee on a percentage basis of 0.40%. Right, that's $400 divided by 100,000. Now, every year your account value grows, your fee stays at 400. So that percentage represents a smaller and smaller percentage every single year your account grows. Right? If you're doing, let's say you have a $200,000 balance, right? That would be in half. You'd now be at 0.20%. Right? And it continues to drop. If you've got $1 million, and I've got clients that do $1 million in their accounts, they'll have $1 million IRA rollover or something of that nature, right? So if you've got a $400 fee on $1 million account value, that's 0.04%, right? Like, that's substantially lower. Okay, now check this out. Let's use the $1 million example, or let's use the $100,000 example actually, because that's what we started with, right? Now let's say you're paying 3 to 5% in fees, right? Or let's say you're paying, I'm going to show you a calculator here. Let's say you've got 100,000 in your account, and you are going to be investing for another 20 years. You're putting no money in. Let's pretend this is a rollover. You're putting $0 a month in. Right? 0. Right? And then let's just take a look at what would the fees be. Right? Annualized return, let's say it's 8%. You have an annual fee of 4%, which is the difference in that 3 to 5 that I mentioned. We have an annual fee of 1.5%. And then we have an annual fee of 0.40, which really at the first year becomes inaccurate. But let's use that, right? At the end of this time period, right, we've got our various fees. Okay, so you've got your first fee, 4%. On a 4% fee, your account value at the beginning of year 21 is only $219,000 because you're paying a 4% fee, right? You put in 100, you waited 20 years, it only doubled once. Okay, now what about a 1.5% fee, right? On a 1.5% fee, at the beginning of year 21, you have a $352,000 balance, right? Now, what about the 0.4%, right? On a 0.4% fee, you have $432,000. Now, the 0.40 is inaccurate because $400 off $100,000 is only accurate the first year. See what I mean? So what I want to do is I want to back the fee out. Let's call it 0. Right? And then let's just do the math on this. We can look at, okay, we've got $466,096. The fee of $400 a year times 20 years is $8,000. Truly, that's what you pay in fees, right? So 466 minus $8,000, you're at $458,000. So you literally have double the money on the 4% fee, more than double the money. Right? You've got 352 on the 1.5% annual fee versus 460 or 458 on the self-directed fee. right? If you did nothing different, like literally if you self-directed your retirement account and did nothing different and bought all the same mutual funds that you usually would buy, and you just did it with the fee structure of a self-directed IRA, you would come out on top. Right? Now, believe me or not on this, I believe I can make higher than this in real estate. I think I can make 10s and 12s instead of 6s and 8s. 6s and 8s, I can do that all day long in the stock market with mutual funds. I can do real estate and make a 12% return if I want to. So let's say I do that, right? And I do make a 12% return. And I do a real estate investment. I'm not telling you you should or you can do this. It's just math, right? But if I do a 12% return on real estate at the beginning of year 21, I have $964,000 as opposed to $350 or $150, right? So the fees here, really, they don't add up. And I want you to think about, like, if you're paying your advisor, what's the difference between $1 million and $350,000? Think about that. What's that math difference? 650 grand? That's the amount you're losing to fees and opportunity costs. So when you sit down once a year or twice a year to have that meeting with your special someone that does your financial advisory, is that really $600,000 worth of value to you? Right? Like, that's more than you're making. If you're doing a 1.5% fee on an 8% return, you're going to grow that $100,000 to $350,000 over 20 years. Whereas you could be doing maybe $1 million, and that's a $600,000 difference, right? That's double. Your loss on what you could be making is double than what you actually have in your account. I want you to think about that. Next time you go to that meeting and they basically sit down and read you what your statement says and tell you, oh, it's a long-term game. If it's doing well, let's keep buying more. If it's doing poorly, keep buying more because it's on sale and just wait it out and it'll get better. Like, that's not worth the $600,000 in lost opportunity with your retirement account. It's just not, right? So this is the world of self-directing. I hope that gives you some information on this and it really opens your mind to what's out there, because this is a whole world, right? This is a whole world of opportunity to invest. Now, the final thing is, if you're watching this, what I'd like to do is I want to give you a free copy of my book. Right? So if you go to jerryfetta.com/B2F promo, you can get a free copy of my book, How to Create Wealth. Or sorry, not How to Create Wealth, Blueprint to Financial Freedom. You can get a free copy of my book, Blueprint to Financial Freedom. Right? Now, the reason I want to give you this is going to give you a deep dive into the different methods of building wealth, because the things we covered tonight, this is how the top 1% do it. They're not sitting down with a banker or a financial advisor and saying, hey, sell me mutual funds and charge me 1.5% a year, or 3% a year, or 5% a year in fees. Right? They're doing what we discussed this evening. Okay, so if you go to jerryfetta.com/B2F promo, you can get a free copy of my book, Blueprint to Financial Freedom. Right? I'll put this up on the whiteboard as well. And if you're watching this and you've been considering getting into the self-directed space, I want to challenge you, if you're thinking about this, I want to challenge you to find a company that's going to give you a $50 setup fee, $400 a year annual fee, and literally hold your hand the whole way. Help you with the setup of the account, educate you on your options, help you with the management in the self-directed space. You will not find this. It doesn't exist out there. I built this in a way that it's untouchable. No one else has this kind of a setup, right? So if you're interested in learning more about that, you can. Again, the place to start is go to jerryfetta.com/B2F promo. Get a copy of the book, start there. I don't work with people who won't study. I want to make that very clear. In my company, we want you to learn, and we will help you learn. We're going to simplify it and make it easy, but you need to invest in your own knowledge. This is not, I have a bunch of money and I want to pawn off my responsibility on someone else and hope they do a good job. No, 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 no. You need to take control. And to take control, you need knowledge. Knowledge brings you the responsibility level to have control over your finances. So get the book, start there, read it, reach out to us once you're ready. Thank you for watching. Like, share, follow, and I will see you next week.